In this video, I'm going to go through a thought process you should consider when deciding whether to keep or sell an investment property. It's quite an easy process and it gives you a logical approach to reaching a decision. G'day, I'm Chris Strano, the founder of SUPERGUY, the place where Australians go to maximise their super and build their own retirement plan. If you're new here, make sure that you click that subscribe button and all the links related to this video. You can find the links in the description below. If you get value from this video, make sure you give it a thumbs up. It takes 2 seconds and it lets me know that you like the videos and it motivates me to make more. Remember, this is general advice only and you should consider whether it's appropriate to your personal needs and circumstances before acting on it. Alright, let's get started. A common question people ask in their lead up to retirement is whether they should sell their investment property. Now, just to be clear, I'm not talking about whether the property market is good, bad or ugly. The purpose of this video is to understand the things to consider that will help you decide whether it's better to continue owning an investment property in your own name or sell it and contribute the proceeds to super before it's too late. Let's take a look. We're going to cover off on things that you need to think about when analysing your property as an investment and what the benefits and risks are of the decisions that you make. And there's 3 main considerations that I like to look at. So I like to look at investment returns on their property, super versus non-super, the pros and cons of investing inside and outside super, and the superannuation contribution caps. So to do this, maybe it would be best to set up an example scenario. Now, this may or may not be similar to your situation, but at least it'll give you some things to think about. Let's assume that Mark and Lauren are both 60 years old and working full-time. They each have $500,000 in super and own an investment property in joint names valued at $800,000, which was originally purchased for $500,000 5 years ago. The property is providing rent of $550 per week and has expenses of $8,000 per year. Including rental costs, management, maintenance, rates, and so on. Now, as Mark and Jane near retirement, they're wondering whether they should hang on to the property or not. So, as I mentioned, some of the things they should consider are investment returns on their property, super versus non-super, and contribution caps. Let's begin with investment returns. So basically, anytime someone asks me what they should do with their investment property, the first thing I do is ask 3 questions. What's the property worth? What rent do you receive? And what are the expenses? So looking at Mark and Lauren's situation, they have a property worth $800,000 and receive rent of $550 per week with expenses of $8,000 per year. So the first thing we need to do is convert the income into an annual yield. As you might know, the gross yield is the amount of annual rent divided by the property value, expressed as a percentage. So in this case, $550 per week rent is $28,600 per year, divided by 800,000, which gives us 3.57%. Okay, so not fantastic, but not the worst. And really, it's all relative based on the risk-free return and comparable investments, but we'll get to that in a sec. But what about the net yield? We need to take into account expenses associated with the property. So we know that $550 per week is $28,600 per year, but we now need to deduct $8,000. So $28,600 minus $8,000 is $20,600. Divided by 800,000 gives us a net yield after expenses of 2.57% per annum. The net yield of 2.57% is the actual amount received. But Mark and Jane will still be taxed on this amount. They're both working full-time, so for simplicity, let's just say, after depreciation and all that, let's just say tax is 30%. So the $20,600 net rent is reduced by 30%, giving an after-tax rent return of $14,420, which is an after-tax yield of 1.8%. So this is the very first calculation I do when assessing an investment property. Then I look at an essentially risk-free rate of a term deposit to compare. So jokes aside about how secure the banks are and all of that, it's what we've got to work with at the moment, and most people will agree that an Australian bank deposit is relatively secure. So let's say that a term deposit offers an interest rate of 1% per annum. This means Mark and Lauren could invest their $800,000 and receive a net yield of 1% minus 30% tax, providing an after-tax income return of 0.7% per annum on a term deposit. So these two calculations, what the effective after-tax return on the property is versus the effective after-tax return of a risk-free term deposit is, provides a good perspective on your investment. Of course, your numbers could be completely different. You might be achieving significantly higher rent on your property. You might incur less expenses. You might be able to get higher term deposit rates or lower. That's not the point. We're not debating the figures I'm using. I'm simply sharing a framework that you can use to assess the viability of your investment property. Another thing you need to keep in mind is that I've assumed the property has uninterrupted tenancy and that the $550 per week rent is received every single week of the year. But what about if there's a change in tenancy and so forth? So you might want to remove 1 or 2 weeks rent per year from the calculation if you want to provide a more realistic calculation. That's up to you. Not to mention the impact of a pandemic on rental incomes and the ever-increasing rights of your tenants, but that's another story. Now, I realise many of you will be thinking, Chris, you haven't taken into account that my property will be increasing in value over time. And you're right, this is true. We've only addressed the income returns, not the growth returns, and we need to add this into the equation. So what will your property increase in value by? And this one's a bit trickier. With the income return, we know exactly the rent being received, we know the expenses, and we have a pretty good idea of the property value. So we can easily figure out the yield. But the growth side is much more speculative. You might want to use a long-term average rate of maybe 2 to 4%, which is reasonably conservative, I guess, but, again, that's subjective. Or possibly you might want to use a higher return if you think that your property is in a desirable area, but don't discount the possibility of your property going down in value, especially if there has been years and years of continued growth, because the music will eventually stop. Either way, in determining whether you should keep your property or sell it and contribute the proceeds to super, that is step 1. I always compare the return against the risk-free rate and then think about the blood, sweat and tears involved in holding the property and whether it's worth the extra return. But then again, maybe your property is easy to manage, has good, reliable long-term tenants and has good growth prospects. The next step is comparing the two options, retaining the property versus selling and contributing to super. So what's the downside of selling and contributing to super? Well, if Mark and Lauren were to sell, they would be realising a capital gain of $300,000 because they bought it for $500 and they're selling it for $800. Being joint owners, this gain is split equally between them for tax purposes, giving them each a gain of $150,000. Because they own the property for longer than 12 months, they will also receive the general 50% CGT discount, which reduces the assessable gain to $75,000 each. This assessable gain will then be added to their other sources of taxable income and taxed at their marginal tax rate. So if for simplicity purposes we again assume 30% tax on this gain, then they would each pay $22,500 in tax, which is $45,000 combined. And this is quite a hefty sum. But they might be able to reduce, some of the assessable amount by making deductible contributions to super, or, maybe even including the use of the carried forward unused contribution caps, which we'll get to in a sec. Now, eventually, you will probably sell the property. So one could argue that CGT will need to be paid at some point anyway. But another option might be to wait until you're retired before selling the property, whereby you have no other taxable income, which will effectively reduce your marginal tax rate and the subsequent CGT. In fact, it is possible that you'll pay no CGT in this scenario when using deductible contributions to super. You just want to make sure that you're still eligible to make the contributions to super once you're retired. Either way, CGT is definitely a huge consideration when determining whether or not you should be selling an investment property, and your accountant and your financial planner will help devise a plan for minimising CGT. Another downside of selling a property and contributing it to super is that depending on your age, your super may not be accessible to you if you need to access the funds between now and retirement. So you don't want to be tying up funds in super if there's a possibility you might need them. You might also find that whatever you decided to invest the proceeds into after contributing it to super, that it doesn't perform as well as what your investment property would have done had you held on to it, and therefore you end up earning lower returns. Okay, I'm not saying all this will happen, it's just these are some things to consider. These are the risks. Okay, so that's the downsides of selling a property. What about the benefits? What are the benefits of selling a property and contributing it to super? Well, the main benefit of contributing to super is that when you invest within super accumulation account, all investment earnings are taxed at a maximum of 15%, and capital gains tax is only 10% when the investment owned within super was held for longer than 12 months. But it gets better, because once you meet a superannuation definition of retirement and start an income stream, all investment earnings are completely tax-free. Whereas if you had continued to hold the investment property in your personal name, the income will always be assessable at your marginal tax rate, and you will have to pay capital gains tax when you eventually sell the property. Especially if you think it's going to increase in value, then that capital gain will, get higher and higher over time. Another benefit of contributing to super, and one that many people don't consider, is that it provides liquidity. You see, for most people, retirement income will consist of a drawdown of investment income as well as capital. So with managed funds and shares, this is easy because you can simply sell small portions of the shares and the managed fund units each year to meet the capital portion of your retirement income requirement. But with property, you can't go and sell the bathroom or the downpipes. You need to sell the whole property. And if you will inevitably need to sell the property for liquidity purposes, you need to ask yourself whether it would be better to do it now or later, taking into account future capital gains tax, age limits on getting money into super, and contribution caps of getting money into super. Contributing to super can also provide greater diversification. So think about it. Having a large portion of your retirement plan hitched on one investment property can be seen as risky. You've worked your whole life and you're basically crossing your toes and your fingers that this one property does what it's meant to do. But what if it doesn't? We've seen it all before. Property crashes, bad tenants, COVID rent reductions, and as the old saying goes, you should never have all of your eggs in one basket. The other consideration that needs to be made when determining whether to retain your investment property or sell it and contribute it to super is how much you can get into super. Okay, so the concessional contribution cap is $27,500 per person per financial year, and the non-concessional contribution cap is $110,000 per person per financial year. You might use concessional contributions to offset some of the capital gains tax resulting from the property sale and put the rest in as a non-concessional. That's something you'll go over with your accountant. Now, there is, of course, potential to contribute more into super as a concessional contribution using the carry forward cap rules, which allows you to utilize unused caps from previous years in certain situations. And obviously, if you're a member of a couple, you each have access to your own concessional and non-concessional cap. Also, with the non-concessional cap, you can take advantage of the bring forward rule while you're under age 67, which effectively allows you non-concessional contributions of $330,000 per person per year. Per person over a 3-year period, which is particularly useful when you suddenly have a large amount of cash from the sale of a property, for instance, but this option isn't available to you forever. So keep that in mind. So depending on how much the investment property sells for and how much is left over after paying any debt, you might be able to get all of it into super, especially if you're a member of a couple, because you each have the caps that can be utilized. But leaving the sale too late, for instance, after age 67, or if you have multiple properties, you could severely be limiting the amount that you can get into super if you leave it too late, which means you could be missing out on the benefits of tax-free investment earnings all the way through retirement, which, could be another 30 or 40 years of tax-free investment earnings. So as you can imagine, the decisions that you make now regarding your investment property can really make a difference in relation to the level of income that you need in retirement. Now, just to be clear, I'm not telling you to sell your property or not sell your property, because your situation will be unique and there are many factors that you need to consider, such as the return on your property, potential CGT, your retirement objectives, your age, and so on. It's just a bit of food for thought to allow you to analyse your specific situation. Well, there you go. I hope this makes your decision to keep or sell your investment property easier. If you've learned something new from this video, make sure you subscribe to my channel. If you want more exclusive tips, head over to superguy.com.au and sign up to my newsletter for free. That's where I share my best content. Thanks for watching, and I'll see you on the next one.